Happy New Year and good afternoon, dear clients. The RCBC Wealth Management Group would like to welcome you all to our first market update for 2022. Today, we will be tackling the impacts on the economy and financial markets as we move closer to normalcy this year, despite the new COVID Omicron resurgence. I'm Dee, a relationship manager of RCBC Wealth Management, and with me is Mr. Mike Ricalde, a wealth management RM as well, who will be facilitating our discussions later. Hi, Mike.
Hey, how are you?
Good, good. How are you?
Good. Happy New Year. And
Happy New Year to you too.
first and foremost, I'd like to greet our valued clients, colleagues, and guests a Happy New Year and a warm RCBC Management welcome to all of you.
Yes, and just a few reminders to our participants. Our audio functions will be placed on mute for the whole webinar, so please feel free to type in your questions on the Q&A chat box. Our research team will be answering them while the presentation is going on. Mike will also be picking some questions from the chat box and will directly ask our resource speaker during the Q&A session later. Now on to the highlight of this afternoon. To our clients attending for the first time, please allow me to introduce to you one of our celebrities here in RCBC. Mr. Mike Ricafort is the chief economist of RCBC and a frequent resource person at various media companies and TV shows such as ANC, CNN, Bloomberg TV, or Business World Live, and so on. He was also ranked by the Department of Finance as the most accurate in predicting the Philippine GDP for 3 years running, and recently received an award for being the closest to predict the country's GDP growth for third quarter of last year. Hi, Sir Mike. Happy New Year po. Thank you for being with us today.
Hey, thank you so much, Dee, for the generous introduction. A pleasant afternoon and Happy New Year to everyone. We hope that we'd make this economic briefing as productive as possible as we start the year, and hopefully you'll be able to get new insights as this may help in your planning for your investments and other business. So I'd like to start my presentation. Let me share the slide. Okay, so this is the title of our briefing is all about going back towards normalcy. Actually, we were almost there. We were almost back to normal. It was just disrupted by Omicron. Had it not been for Omicron, foreign tourism would have been back already by December, and that's one of the missing puzzles towards normalcy. Also, another thing that would complete normalization is the face-to-face classes. But unfortunately, with Alert Level 3, that has been postponed for now for those areas under Alert Level 3. So definitely, we were kind of, because November 5, that was really the cutoff. November 5, when Metro Manila was eased to Alert Level 2. Many businesses and industries, again, allowed to open, including tourism. Then, all of a sudden, November 25, Omicron came. So, and of course, during the holidays, actually, if you notice, during the holidays, it's almost back to normal. It just happened during the gatherings that triggered the spike in cases. But at least, even if Omicron is highly transmissible, but most of the cases are relatively mild. So I like to present three major themes for this year. First is the resurgence of cases, because just a month ago, our cases are already at pandemic lows, between 100 to 300 per day. Then suddenly yesterday, we saw a new record high of 34,000. But most of them are mild cases. But still, there are still warnings by health authorities worldwide, especially by U.S. health expert Anthony Fauci, that there's still a potential to overwhelm the healthcare systems around the world. That's also the warnings from the World Health Organization, uh, that it's not really prudent to say that it's mild because it could still cause some hospitalizations and unfortunately some deaths, especially those with with comorbidities and the vulnerable sector, especially the unvaccinated. Now, so that's one. The resurgence in cases, that's the major theme. It could slow down the economic recovery, but look at commodity prices; they continue to go up. Even oil, yeah, it corrected lower early December upon announcement of the Omicron variant as a variant of concern. But oil just already raised all its declines. It's back again to new 7-year highs because the markets reckoned that the relatively mild cases so far, an overwhelming majority, that would still lead to, well, at least the recovery story remains intact. That's the bottom line for the rest of the world. Then the second major factor is the tighter U.S. monetary policy. We have been hearing the signals from the U.S. Central Bank, the U.S. Federal Reserve, more rate hikes. They're about to start the rate hikes by as early as March. That's already the consensus. Uh, Suddenly, they became more aggressive because this is really nothing new. In fact, the markets have already priced in the tighter Fed. This has been ongoing since June of last year. They would like to manage expectations properly, learning from the lessons more than a decade ago. But the only difference now and then is that when they started signaling the tapering to take back some of the unusually or extraordinarily easy monetary policy, is that back then the expectation was just a hike of 25 basis points each for 2022 and 2023. Now, it's 50 basis points higher for both years, no? 75 basis points hike for this year, another 75 basis points hike by 2023, and 50 basis points by 2024. However, of course, there are already calls by an increasing number of Fed officials for 3 to 4 hikes of 25 basis points each for this year. And the earliest that could happen is March of this year. But hopefully that's already priced in because at least there's already some decoupling. The dollar index has already declined to 2-month lows lately, despite the more hawkish Fed. And US stock markets, yeah, it may have corrected slightly low, but S&P 500 is still near record high, despite that. No? And the third one is the presidential elections. Yeah, this has been priced in already for the past couple of months. At least for the past 1 to 2 months, based on the surveys. But of course, the surveys could be volatile. The campaign period would start next month, so things could still change. But what's for sure, there would be a honeymoon period of between 6 months to 1 year. Then some wait and see attitude. Of course, the whoever may win the elections, we have yet to see details on the policies, reforms, governance, and other programs. But there's a good chance that they would continue. The continuity of the existing reform measures, like even in infra spending, but more importantly, how would they manage the country's debt, the fiscal performance? Well, considering that we came from the pandemic, and the pandemic has, for the past 2 years, has widened the budget deficit and increased the country's debt. But so far, so good. We haven't really seen a downgrade yet, unlike the downgrades that we have seen in other countries. There's still some resilience because we came from relatively low debt to GDP ratio, and that provided some leeway for the country to weather the pandemic. So maybe just to size up these three factors again, it's it's COVID with Omicron. Second is the tighter Fed policy. It's actually normalization. It's just bringing back to more sustainable levels from unusually low interest rates, from record low interest rates for both short term, and the bond yields have gone up already, by the way. It's back to pre-pandemic levels for most US bond yields. But here in the Philippines, the bond yields have been back to April, around April 2020 levels. It's already near pre-pandemic as well. So what would be the impact for, say, for the exchange rate? It's a mixed signal. The pandemic, we don't have, well, we're already at alert level system. We don't have large scale lockdowns anymore. So it's granular lockdown already since November for the whole country. So the big lockdowns, those are already a thing of the past. Meaning, we all know that the peso appreciated when there were big lockdowns, hard lockdowns, because that disrupted economic activity and importation. But now, with the alert level system, not that much. The reopening of the economy would still continue, especially if cases start to ease again. If you compare it, at least comparing it to most of 2020 and 2021. So the reopening is of the economy is still intact. Well, the alert level system would be the main barometer for that. So that's why the peso, it didn't appreciate so much despite the spike in the Omicron, partly because of that reason. And at the same time, global commodity prices, especially oil, remain elevated. So yeah, that's a consequence. If the economy has been reopened further, even importation would pick up also. And the import bill has been bloated by oil has been near 7-year highs. And the global commodities are near decade highs lately because of some of the supply side disruption. But another thing is the Omicron could also aggravate the disruptions in the global supply chain. Even before Omicron, there have been already disruptions. No? That's why, well, because supply cannot simply catch up with the recovery in the economy, the pickup in demand, because the various production manufacturing activities worldwide for many products like electronics, they have been disrupted by the pandemic. All the more now because of the highly contagious variant. Imagine many workers. Those who were infected, that would mean less productivity for many businesses and industries. We have seen that already tangibly, no? In many industries. For instance, in airlines, you could see it right away, no? Because people, the infected people, the workers, and the employees, they have to isolate and they have to also quarantine for a few days. No? Even in the healthcare system and many other industries. You know? So that could aggravate initially the disruptions in the global supply chain. That's one of the reasons why global commodities, many other commodities remain elevated in terms of price as a result, despite the Omicron. That's one consequence. Yeah, it could slow down the recovery a bit because of the restrictions on travel, on flights, on mobility, yes. Yeah, because foreign tourism, as I mentioned earlier, the resumption of which has been delayed, especially in this part of the world, in Asia. Then on the tighter monetary policy, yeah, that's already priced in. So what's the bottom line there? Short-term interest rates are still near record lows. For instance, here in the Philippines, the PHP B-Val yields, even the T-bill yields close, the short, for instance, the 3-month is around a little less than 1%. They're still near record lows, about 10 to 20 basis points from the record lows. Well, unlike the bond yields, the 2 years and longer, especially the 5 years and longer, they have gone up already by about 200 basis points, more than 200 basis points from the record lows, because especially since the recovery started. The recovery story really accelerated when the vaccines came out December of last year, December of 2020 rather. So that started the recovery, and that's even affirmed by the hawkish Fed statement since June of last year. So bond yields have dramatically gone up already, while the short-term interest rates are still near record lows. The two-year tenor, for instance, locally, has only gone up by 80 basis points from the record low. So it's still near record lows for them. So the bottom line, once the Fed starts to raise rates by March, there's a chance for other central banks to also increase rates. Like the BSP would also follow, but to a lesser extent. Maybe, for instance, if the Fed would hike by, say, 50 to 75 basis points this year, the BSP could raise by a lesser extent, say 25 to 50 basis points. We have to take note that the BSP at the start of the pandemic in 2020 was among the most aggressive in cutting rates by 200 basis points. The policy rate from 4%, they cut it to 2%. The current record low, it has been there since November of 2020 for more than a year already. So that's one of the reasons also why the BSP governor received an award of being the best central banker in the world, no? Because of that, no? So that's a good signaling on the part of the BSP that they won't necessarily follow the Fed in lockstep, no? So it would be by a lesser extent. But one thing is for sure, yields would go up. The central bank has already signaled for the first half of the year, they would keep the policy rate steady. But for the second half, that's the time that they would already start considering any hike. Well, for the simple reason also that because inflation has gone up already around the world. Inflation is already elevated. Here in the Philippines, inflation is at 4.5%. The average of last year. For this year, it would average between 3 to 3.5%. It would start to normalize already. In the US, the latest inflation figure is 7%. So if you look at short-term interest rates, they're very low. The Fed funds rate zero. So it's very far from inflation. Even if inflation normalizes to 3 to 4%, the policy rate is still very low because the record low interest rates were really meant to support the economy at the height of the pandemic, but that's already behind us. So there's a need to normalize it higher from that unusually low levels, no? From the extraordinary accommodation or the unusually accommodative monetary policy. So there's a need to normalize it already because they need to also control inflation, both inflation and inflation expectation by way of tightening monetary policy, by way of higher Fed rates. And the rest of the world would follow. At the very least, the inflation expectations would also behave properly, or at least they would become more anchored because inflation is a threat that could jeopardize the recovery and the sustainability of economic growth over the long term. You don't want spiraling prices. That's the least that you would need because inflation in the US is already at the highest in nearly 40 years since June of 1982. So they don't want it to spiral. So yeah, so at least that's already being priced in already by the markets. Now, I'll just elaborate on other parts of the market. With elections for sure, that could be another thing to consider also. Well, now let's go to the specific details. This is the forecast for this year, 6 to 6.5%. Last year, it's around 5.5% for the full year. We'll see the data in the next couple of weeks for the full year figures. The exchange rate we estimated to range between 51 to 52. Now it's doing around 51.10. Well, at least the BSP has been clear that it would manage the volatility. It would smoothen the volatility. During the height of the pandemic, even as middle of last year, when the peso appreciated to 47.80, 47.70, 47.80 levels. So that's the strongest for the peso last year. The BSP has been there. They confirmed it actually. they were smoothening it when it was appreciating at 48 to 49 level until it reached that low for the dollar at 47.70, 47.80. They were buying there. Now, for the past, at least since late September till December, for 3 months, the peso hasn't reached 51. So that's also a signal that the BSP is also managing the volatility there. And they've confirmed it actually just this week. So right now, the high of the exchange rate of the dollar peso is 51.45. And it has the high has ranged between 51.30 to 51.40 levels. So yeah, it's pretty clear that the BSP is there. It's smoothening at somewhere between currently at around 51.10 to around 51.30 to 51.40. So that's a signaling that they're sending to the markets. That what's the major resistance for the dollar peso is around 51.70 to 51.80. That's very critical. That should not be exceeded, because if that's exceeded, based on the charts, the technicals will suggest that that could still suggest further upside. But that's one of the reasons also why the smoothening activities are there, no? To prevent, or at least the peso would be behaving. I'll show some figures later on. Inflation would, at least inflation, because we came from a very low base in 2016, 2.6%, when everything else slowed down. The economy it contracted in 2020 by almost 10%. That's the worst since World War II. So prices also went down. Then we have the recovery last year. We came from a low base, so it's 4.5 that exceeded the official target of the upper end at 4%. And hopefully for this year and in the coming years, it would stabilize at 3% level. So that will be the ultimate valuation for interest rates and fixed income. So the policy rate of the BSP from the current 2% since November 2020, it would rise to around 2.5 to 2.75. So that's less than the 75 basis point signal of, the Fed rate hike signaled by the Fed officials. Yeah, they're seeing somewhere between 75 to 100 basis point hike this year. So from zero, this is the current level, 0 to 0.25. So, and the PSEI, well, it's almost at 7.3, a little less than 7.3. No, it has gained already, at least for the second week of the year. Well, we're estimating it at between 7.5 to 7.8. So that could be, if things go well, especially on the elections, and of course, in better controlling the COVID cases and Omicron. So there's a good chance to hit this much earlier, actually. This is kind of conservative, the 7.5 to 8,000 target. It closed last year at 7.1. So even the consensus estimates by the multilaterals, the World Bank, ADB, IMF, as well as major credit rating agencies, they're seeing GDP growth of at least 6% this year. And next year, the World Bank estimate there, so it's still close to 6%. So this is very important. Actually, the vaccination, this is one of the best ways to really counter the threat of Omicron and COVID cases. So, please note that the total vaccines administered in the country, it's already at 117 million. So imagine our population is 110. So it's more than the population already, believe it or not. So one thing is for sure, fully vaccinated is already 54 million. And that's already nearing 50% of the population. And those with the first dose already at 58 million. Give it 3 to 4 weeks for most vaccines, they would receive their second dose. And AstraZeneca would take about 2 to 3 months for the second dose. So around 2 months, in 2 months' time, a lot of them, most of these who received the first dose would be fully vaccinated. We're already reaching, the country is already reaching herd immunity before the elections. As early as March, April at the earliest. 80 to 90% of the population would already be fully vaccinated. And the booster doses have been increasing. It's already at 4.4 million. This is very important, versus Omicron as well. But it doesn't guarantee full protection, but it's helping a lot because the vaccinated people, even those with booster doses, would only there may be some breakthrough cases, yes, but at least it's still, the cases have been mostly overwhelmingly mild and manageable, less risk of hospitalization and less risk of fatalities. Even in Metro Manila is already in population protection. It's also leveling up to herd immunity already. And then, so this is for the regions. At least the regions are also catching up for the vaccination. And yeah, so yeah, this is the graph of the cases. So the spike was really led by the gatherings during the holidays more than anything else. These are the deaths. So the deaths have been relatively low because of the protection given by the vaccination. And there are already medicines or pills versus COVID, especially to protect also the unvaccinated as a fallback. Look at this. This is very interesting. Omicron started in South Africa. It was detected there on November 25. Look at the cases. It reached a high of 37,000 December 12. That's more than 2 weeks since it was detected. But now, the case is there already. If this is at least, this is a source of hope that, well, let's see. We have been hearing some government officials predicting that later by around February, that cases will start to ease. Well, at least by nature of this, and more importantly, of course, the need to maintain the minimum health standards and protocols, the social distancing, because the gatherings really triggered the spike in cases. This is in Germany. The peak was in early part of December. They had one of the first countries to experience a spike in Omicron was in Europe, particularly Germany. But it already eased. The cases already eased despite the holidays. Well, in UK, it's still relatively elevated. Omicron is also, this is also one of the earlier countries hit by the recent surge. It's still elevated in the UK. But surprisingly, look at some of our neighboring countries in Asia. Look at Malaysia. It's still relatively low. They maintained it because maybe it had to do first the increased vaccination, some of the restrictions also, the minimum health protocols, and of course their culture is different, and because of they have their religion, of course, is different also. So they don't have the celebrations, the holidays last December. The vast majority of the population, they don't observe it. Christmas and etc. Look at Thailand. There was some spike, but not as worse as the other kind. Vietnam was they only experienced the surge later this year. So it's still relatively elevated in Vietnam. Unlike the other countries, they already experienced a surge since 2020. But Vietnam, they only experienced it the second half of 2021. They almost had no cases, no? Up to the early part of last year. Look at Indonesia. They maintained it at relatively low levels because they're predominantly Muslim country. They don't have Christmas, the holidays that's normally celebrated during the gatherings in December in many other countries. So they were able to maintain the low number of cases. And of course, the increased vaccination, the other, the stringent protocols. But the story is different now with India. India experienced a spike. well, because of the sheer number of population, it's of course multicultural. Um, it had to do also with yeah. So some of the celebrations also, the gatherings in December. This is the cases. Well, the number of cases in the U.S. It reached a record high of just this week, this last Monday, almost 1.5 million in a day. The week before that, January 3, after the New Year holidays, it was around 1.1 million. So you could easily trace it with the gatherings during the holiday season. And they had Thanksgiving also last November 25. But look at the deaths in the US. It's also relatively controlled because of the increased vaccination. Because the deaths, the overwhelmingly accounted for by the unvaccinated in many other countries around the world. So, yeah, the markets are also preparing for the elections. So, at least we have seen some increase in infrastructure spending also. Because there's a 45-day election ban from March 25 to May 8. So, yeah, plus the election spending, that could be a driver. But of course, now it's really the whole world. Well, the investors are now very much compliant with ESG standards, environment, social, and governance. So same goes with the election, especially the winning candidate. Yeah, these are. Well, I'd like to briefly show. Well, the survey, the leading is. This is the ranking of the leading candidate for the presidential elections. So it's led by Marcos Jr., then followed by Robredo, then Isko, then Pacquiao. On the VP race, the latest survey by Pulse Asia. So, well, actually, first this is the alternative view. Well, assuming if say Marcos Jr. is not in the race, so the one leading is Isko, then followed by Lacson, then Robredo. Then here's for the VP race, led by Sara Duterte, Tito Soto, and then Kiko Pangilinan. So it's really the continuity of the reforms and the other, well, of course, governance standards. That's very important given this increasingly ESG orientation of global investors. Put more money here in the Philippines. It's one of the preconditions, and that could greatly affect sentiment. So these are the economic bills. So it's moving. No? For the past, well, at least for the past 3 to 5 years, we have seen many legislative reforms being passed. So this is our team actually. So what would be the pillars for? So how would the economy recover? Well, recover. So we would be back to pre-pandemic levels. Our GDP in the latter part of this year. So imagine 2 years wasted because of the pandemic. Yeah. Because had it that's a reality. No? In view of the contraction of 10% in 2020. So if there's a growth of around 5.5%, we just recovered the economy is just 95 to 96% of pre-pandemic levels. It would only be this year that we will be back to 100%. So 2 years practically, well, two years delay because of the pandemic, and that's the rest of the world that has experienced that. But the country has undergone one of the longest lockdowns in the world, and until recently, until the adoption of the alert level system since November. So the recovery of other industries may take longer, like tourism. The view of the IATA, International Association of Airlines, the pre-pandemic levels for flights will be around 2024, and they even predicted that prior to the recent surges. Well, property, vehicle production, the other big ticket industries, the recovery would take around 2 to 3 years from 2020. So meaning that would be 1 to 2 years from now, from where we are. Then, of course, the important pillars is to further reopen the economy, because this would really solve a lot of problems that the country had experienced since the pandemic. And this is already being done. Then the accelerated rollouts of of the vaccines and the booster doses. Because that's the best protection for the population to prevent the resurgence, or at least mild cases. That's at least could that could be secured. Then increase infrastructure spending, especially in preparation for the elections. This is one of the biggest stimulus measures that's readily available. There's funding for that with the budget, the timely approval of the budget, especially. The CREATE law, this would positively impact profitable company with positive taxable income, because tax rates have been reduced by 5 percentage point from 30% to 25% for big companies, and well, the smaller companies by 10 percentage points, those with assets of up to 100 million pesos. So yeah, they would benefit that. This is retroactive July 1. Well, the conglomerates have been benefiting from that. And lastly, the accommodative monetary policy. Near record low policy rate of the BSP at 2%, because I think short-term interest rates remain relatively low. That's also translating to lower credit costs being passed through. So this is a summary of what we have discussed. The pivot here is 2020, since the pandemic started. So the recovery is 2 to 3 years, so that would be around this year up to next year. For property sector, for vehicle sales. Then global tourism, so it's around 2024, as mentioned. But oil has, well, the International Energy Agency already estimated much earlier recovery, latter part of this year, for pre-pandemic oil demand. NPLs have started to ease actually from a peak of 4.51 2 to 3 months back. So with the reopening of the economy, that is already. Let's see if Omicron would have some adverse impact. Yeah, this is the graph of the NPL ratio. So the immediate high is 4.51 last July and August. Now it's 4.35. So here are the industries that are expected to do relatively better. So still allied to infrastructure, those who can work remotely or from home, even BPOs. At some point, BPOs are 90% work from home, especially at the height of the pandemic. The essentials, of course, would still be there, given the prudent and conservative stance for many consumers and businesses. Pharmaceuticals and medical industries, of course. Hygiene industries to keep our people and customers safe. And telco, of course. Telco has been one of the bright spots. They would benefit. Well, they would benefit from remote work, remote study, and remote businesses. Of course, the utilities, delivery services. This is a new norm. Online businesses, the increased digitalization of many processes, and not only for business but also for government. Outsourcing. If you notice, whenever there are crisis periods, the past session, outsourcing suddenly boom. Like more than 10 years ago, during the global financial crisis, BPOs suddenly boomed in the country. It only started 1 billion per year revenues in 2004. That was more than 17 years ago. Now it's close to 30 billion per year. And because global firms need to stay competitive, they need to cut costs. They need to, well, that's a sad reality. Some of the jobs may be lost in developed countries, but they would move to countries like the Philippines. We're number 2 in the BPO after India, or contact center, call center. Philippines is number 1. Of course, online entertainment. People cannot go to movie houses and they need to more time spent at home or remotely. And of course, the other necessity, the conservative stance on spending. That's why the big ticket, the luxury items, may need to, well, the recovery is much longer for them. And of course, renewable energy. You've seen this. Even the Biden administration is pushing for this. But this is very important because this is consistent with the ESG theme of investment. This this one is one of the highlights for that. Many countries, many companies are already committing to reduce carbon emissions. So they're shifting from coal, from oil to solar, to wind, to hydro, and other renewable sources of power. So expect a lot of action from those industries, the phase out from coal. Maybe to some extent, even nuclear. But of course, there are still still sustainability issues be considered for all of those renewable sources. Well, this would still be challenging for. I mean, if you notice this, these are still a similar set for the past 2 years. Like some challenges for those that cannot work from home or remotely. Those hit by social distancing. Those entailing crowds like airlines, tourism, hotels, catering, malls, non-essential retail, convention, events, leisure, face-to-face education, which the country doesn't have actually. Many other countries, they have resumed already face-to-face because of the increased vaccination that would really support it. Yeah, maybe if there would be more vaccination, especially for the younger people, younger children, from 5 to 11, that could start within a month or two. And yeah, sports and other events. And those, lastly, industries, the big ticket ones, of course, the conservative, because yeah, we know business remains relatively slow, even employment, even some of the OFWs being repatriated. So, yeah, for some of them, those who adversely affected, they would be conservative, big ticket and luxury and non-essential spending. Yeah, it's also shown here. And of course, lastly, those industries that are not consistent to ESG, like those not friendly to the environment, not friendly to society and governance. That's why the elections would also be very important. Well, the winning candidate must ensure to adhere also with this, so the country would attract more foreign investment, especially hot money. So, yeah, this is just a brief background on the country. So, yeah, we're the 12th most populous country. Yeah, we mentioned some of them already. Majority of the population already working age since 2015. More than 45 million employed. Then the Philippines is the fourth biggest recipient of remittances from overseas workers, and we're one of the biggest sources for seafarers, around at least 20%, and the biggest sources of around 20 to 25% for both. So the country accounts for about 10% in the semiconductor supply chain. So we would benefit, of course, with the need for more semiconductors amid the shortage. On mining, at least the open pit mining has been allowed already. Country is the fifth most mineralized country in the world. Third in gold, fourth in copper, fifth in copper. And also it's also a major shipbuilding country, the likes of Chunesi outsourcing here in the Philippines, the one in Cebu. And the country is also the biggest exporter of coconut oil. And we have free trade agreements that would benefit the foreign investors locating here in the country. And that's why it's very important to also for the country to be part of the RCEP. That would also facilitate further free trade. Now, well, this is a summary of the performance of the markets since Omicron. So the peso has been a bit weaker, but the BSP is intervening. The PSEI is down by 1%. Interest rates have gone down. The 3-month is down by 30 basis points, 10 years down by 16 basis points. But the ROP 31 yield in dollars up by 7 basis points because of the higher, it moved alongside with higher treasury yields. Oil is already up by $3 or 4%. Because, yeah, that's a view of the market. There would be, well, with relatively milder cases, so the recovery would likely be intact as well as the demand for oil. US Treasury yields have gone up by 9 basis points to 1.73. That's among the highest in 9 months and near 2-year highs. The S&P 500 is still near record high. And, well, the dollar, the performance has been mixed. The dollar started to go down already after 2 months. So this is the impact on the currency. So how did the peso fare? Well, the peso has weakened much more than the other regional currencies since the Omicron. Well, in fact, the Thai baht even appreciated by 0.6%. The Malaysian ringgit appreciated by 1.1% and the Singapore dollar by 1% since Omicron. So it's kind of an overreaction in the peso's part. The Indonesian rupiah only weakened by 0.2. This is in dollar terms, by the way. This is the performance since the start of the year for the various markets. So the PSCI is already up by 2.2%. And the peso slightly weaker by 0.2%. Interest rates have gone down a bit, except for ROP, because the ROP 31, the yield went up by 33 basis points, because the 10-year Treasury yield went up by 22 basis points. Just the first week of January alone, the 10-year Treasuries went up by 25 basis points. The S&P 500 corrected lower by 2.2%, but it gained by 27% last year. And we have seen already a weaker dollar worldwide. Yeah, seen here since the start of the year. So we have seen some currencies, well, the dollar modestly up for the past 2 weeks. And this is the, well, at least for reference, this is the performance of the markets for the full year 2021. The dollar peso went up by 6.2%. The PSCI down by 0.2%. Interest rates have went up, especially the long end. The short end, the 3-month, it's down. It's almost unchanged, down by 2 basis points. But the 5-year up by 169 basis points. The 10-year locally up by 183 basis points. So bond yields have gone up. ROP 31 bond yield went up by 37 basis points. So the price of the ROP 31 went down by 5.7%. But since this is in dollar, this is offset by the increase in the dollar by 6%. So that's more than covered by that. Oil prices went up by 55% last year. The 10-year Treasury yield went up by 60 basis points. The S&P 500 went up by 27%. The dollar yen, it went up by 11%. That's why it was a strong dollar because of the hawkish trend. That's why one of the reasons why the dollar peso was up by 6%. And the euro went down by 7%. This is the review of, at least for the currency market. How did the peso fare compared to its regional counterparts? The dollar peso up by 6%. That's less than the dollar yen, 11%. And the Thai baht's 11%. Because these are export-oriented countries. They would like, and their interest rates are close to zero. That's why the shift of funds is much more sensitive for interest differential. However, look at the depreciation of the other regional currencies. The increase of the dollar is less in Indonesia. It's just 1.5%. In Malaysia, it's only up by 4% and Singapore 2% compared to the Philippines 6%. So there's some overreaction on the dollar versus most of the major currencies. So there's a graph of oil. So it's still among 7-year highs. That's why inflation remains elevated. It's already up by 9% after last year's 51%. Yeah, because the oil import bill of the country has been bloated as a result of that. This is the dollar peso. So as I mentioned earlier, this is, well, it should not breach this green line. The charts will suggest based on the technicals. This is 5170 to 5180. That should be protected. Otherwise, it could lead to further upside. That's why the BSP has been in the market to manage volatility. consistently at 51 since October, fourth quarter of last year. And now it's there at a little over 51, around 51.10 to 51.30 levels. Yeah, so peso little change is the start of the year. We closed at 50.999, so 6.2%. But during the lockdowns, during the pandemic, the peso appreciated by 5.2%. We're practically back to where we started. And 2019, we were 50.63. Now we're at almost 51, so 50 centavos higher already. So we're just back to where we started. But because during the pandemic, imports were reduced. But now, as I said, that's already a thing of the past. We won't have that those big lockdowns anymore. It's granular or smaller scale lockdowns at the house level, street level, or barangay, sitio level. This is the PSCI. So it has been strong so far this year. 2-week highs at almost 7.3. So the high, immediate high was 7,475 last November. Yeah, it gained 2.4% already since the start of the year. Last year it was almost flat, and during the pandemic it was down by 9%. Look at it. It didn't change much for the past decade. Now we compare it with S&P 500. S&P 500 more than doubled in 5 years, and it more than tripled in 10 years. Yeah, because valuation-wise, even before the pandemic, the world has become increasingly digitalized. Online businesses like Amazon, they're there, Apple. So it's the digital economy that has driven it. They have benefited so much. Much of the business has shifted towards them, and they have dominated the world. So look at it. Year to date, it corrected by 2.2%. But look at the gains. So 2021, it was 27%. 2020, it was 16%. At the height of the pandemic, it made money. In 2019, before the pandemic, it was already making money at 29%. So it was consistent. Well, because there's not much money to be made on the other investments like U.S. Treasuries. The yields are very low, record low levels. You could only earn what 1% levels or less than 1%. Then yields are going up. People could lose money there as yields have been rising. They'll get burned. And the fundamentals are supportive. You have a recovering economy, and the shift to the new economy. Some of those tech shares benefiting from the with or without the pandemic. So that's why, yeah, it does make sense for the big funds to move towards equities and away from dollar fixed income. Yeah, because of this, no? Because the Fed is raising rates, will be more aggressive, as we have been pointing out. Because inflation is very high. They need to control this by way of normalizing monetary policy. The one way to control inflation is to raise rates. Yeah, during the economic cycle. So imagine this is the highest since 1982. The highest since the time of Paul Volcker, the former Fed governor. During the early part of the Reagan administration, they were back then. Interest rates in the U.S. double digit. The Fed fund rate, 10-year Treasury yield, they're at double digit yields back then. So they fought inflation by way of higher interest. But now, of course, things have changed. Productivity has changed. The advent of technology, the increase in efficiency and productivity. And look at this unemployment rate in the U.S. Already the lowest or the best since the start of the pandemic. Actually, this is the lowest since February of 2020. So that further justifies the further justifies the tightening, the need to raise rates already. Because another motivation for the Fed is the bubble, and actually the relatively high increase in home prices. 20 to 25% per year. That's unsustainable. For the past 20 years, during the time of Alan Greenspan, post 9/11, whenever there are bubbles forming in the housing market, that's a motivation for the Fed to raise. Enable to, well, because mortgage rates have gone down to record lows. Actually, that's one of the unintended consequences. So it's cheaper to borrow. So more people, more businesses, they're able to borrow. They buy homes, they buy property. So that's causing the bubble. And now the Fed could again come in and rain on that, no, on price bubbles. So not only in property but in many other sectors. Imagine even used cars are up by 20% because of the shortage in computer chips, in semiconductors for new cars. This is the graph of the 3-month LIBOR, so it's gone up already from record low 0.11. By the way, it only shows that we have seen the best already in terms of record low. So they're already pricing in the Fed rate hike. Yeah. This is the 5-year. It's almost at 1.5. That's the highest in 2 years, pre-pandemic levels already. So no more advantages of that because they've already tapered their bond purchases. I'm talking about the Fed. Yeah, it has gone up by 90 basis points last year. That's just the first week. Oh, barely the first week of the year. It's up by 20 basis points. It is a 10-year, the benchmark for the world, for global bonds. So it's already among, also near 2-year highs, at 9-month highs lately, 1.7 levels, close to, it reached as high as 1.8. It came from a record low 0.3. Yeah, just the first week, it's up by 25 basis points after rising by 60 basis points. So this is local inflation. I think this is important. Our year-on-year inflation would start to ease again from 4.5% to ease to 3% level. That's why our interest rates not much affected by the Fed. In fact, this is week to date. Our yields, most of them corrected lower again for the second straight week, despite the higher Fed. Because we have seen the big moves already. Look at the last column. Long-term interest rates already in the Philippines, the bond yields have gone up by more than 200 basis points. So that's already priced in. The activity of the Fed, the budget, the need to borrow to finance the budget deficit. But look at the short-term interest rates, the last column. From the record low levels, they're almost unchanged. They're just up by 10 to 20 basis points. So the 2 years is up by 95 basis, by 55 basis points. So once the Fed starts to raise rates, the short-term interest rates would catch up, although gradually. The long-term interest rates will still go up, but maybe only slightly because inflation has already normalized. So here's the graph of the 3-month BVAL locally. So it has gone down to 0.95. But then again, there's still excess liquidity. Inflation is easing, but it's still way below inflation of 3% levels for this year. The 3-year, here's a graph. So it has eased a bit to a little over 3%. So the record low was 2.06%. So it has, it has gone up by 120 basis points last year. It is year to date by 24 basis points. Here's the 5-year. So it's becoming steeper and much more expensive for the borrowers here. But it's favorable for the investors, no? Those investing in fixed income, because it came from a low of 2.32. Now it's at 4.14. It already topped out last November. The immediate peak was around 4.4. Even the RTB, the 5.5-year, was doing at 4.625. That's double the record. It has gone up already. So it has gone up by 170 basis points last year. The 10-year, it's much steeper. So now it's doing at 4.80 level. It came from a high of 5.24 last November 16. So it has eased since then. And the long-term average of this is around, for the past 10 years, around 4.6%. And it's still among the highest since April of 2020. So the advantages of pandemic is not there anymore. But from the point of view of the investors, they're in a position to earn more because, especially if inflation stabilizes further, if the elections turn out to be favorable, because it came from a low of 2.6. When it reached 5.24, that's practically double in a little over a year. The yields have doubled. And that's relatively higher compared to the other countries around the world. If you look at the US Treasury, the US Treasury is just doing at, for the most part, around 1.5 to 1.6%. And yeah, last year it has gone up by 1.8%. So this is important for those who invest because they would earn more interest income, accrued interest, and potential trading gains for the likes of banks, insurance companies, pension funds, retirement funds. Because relative to the other countries, especially if inflation starts to normalize. So at this juncture, I'd like to end my presentation. So if you have questions, please feel free to raise them. Thank you.
Thank you, Mike, for that insightful presentation, and congratulations again for the awards and citations you received last year. No, now to begin the Q&A portion, let me start off with a two-part question. Am I coming in clear, Mike? Can you hear me?
Yeah, loud and clear, Mike.
First question would be, I believe you showed several slides on the US dollar, no? So wanted to get your thoughts, or can you give us more color on the USD and why such a forecast, no? And second, how do you see the US equities market behaving for 2022 or in 2022?
Yeah, first on the on the US equities, but it's just correcting lower now, as I've shown and elaborated a while ago. Tendency, well, we had a similar condition more than 10 years ago when the Fed also started to normalize policy rate. Yeah, there may be some slight correction, but eventually it continued to post new record highs, as the charts would suggest also there. It continued, well, S&P 500 more than doubled in 5 years and more than tripled in 10 years. That would attest to it. No? Because interest rates remain relatively low, so there's still some liquidity-driven gains towards equity. And the fact that also as yields are going up, that could mean lower bond prices, especially in the US. No? It's very low. Interest earning is very low, but the interest income. And at the same time, there's a risk of for, if yields go up, the prices go down. And you have the recovery story. So it's really the equities that's benefiting. And our local equities market would also indirectly benefit. Although the local equities market has been almost, it's practically little change for the past 5 years. So it's compared to more than double in S&P 500. The exchange rate, well, the BSP would smoothen it. It was buying at 48, 49 levels. It doesn't want it to appreciate at the height of the pandemic when imports were down. But now it's it has been there smoothening at 51 levels. And currently, at least it came straight. Now, this is kind of unusual for the BSP to confirm that and to say that they don't, it's unlikely for the peso the dollar peso to go beyond 53. And they would smoothen it actually. But of course, maybe the key important figure to watch out is 5170 to 5180. That should not be breached that easily. So, and knowing for a fact that the BSP is there. Because that means, well, the charts would show, as I also elaborated. That's a major resistance prior to further upside potential. So hopefully that answers it, Mike.
All right, thank you, Mike. Another question in the interest rate space or environment, no? Consensus, we see consensus says that the Fed might start hiking rates as early as March. So how do you see bond prices behaving, going into that period?
Well, at least it's already priced in. All of which the Fed has done a good job. They really conditioned the market and prepared the markets better, learning from the lessons of more than a decade ago. Actually, that's May of 2013. That's less than a decade ago, because there was this taper tantrum. The Fed just suddenly surprised the market and did the tapering of bond purchases. under Ben Bernanke. So they learned from that lesson. So since then, well, they applied it now. Since June, they said, okay, we will be more hawkish. We will taper the bond purchases. We will start raising the rates. And now because of the elevated inflation, they adjusted their expectation. They increased it by 50 basis points more for this year and next year. So yeah, hopefully it's already priced in. The dollar index has gone down to 2 month lows already. So it's really nothing new. Even the elevated inflation, for all we know, even the inflation in the US would start from the base would normalize, just like here, because we all came from a low base. That's why the year-on-year change in prices has been elevated. We're already starting to see easing of the year-on-year inflation here in the Philippines, and hopefully that could happen also in the US and the rest of the world. So, and that would make their job a lot easier. But it's still valid because there's still supply disruptions because of the pandemic. So what's really important is to control the cases, to normalize the production, the manufacturing, enable for supplies to normalize, and hopefully the herd immunity would help. And let's see, after winter, the winter is also causing the supply disruption. By springtime, let's see. Hopefully that answers.
All right, thank you, Mike. And in relation to that, Mike, and as a follow-up question, where should our clients position their funds now? In the short end of the curve, the belly of the curve, or the long end of the curve?
Now, depends. Actually, it depends on the type of investor. Those who would hold till maturity, regardless of who they are, whether they're individuals, high net worth individuals, or consumers, or even institutional investors, for as long as they can hold it till maturity, they're insulated with the market rate. Yeah, they just wait for it to mature. They earn the relatively higher interest rate, compared to short-term placements or interest rate, and that's it. Because the problem is, if they won't hold it till maturity, they would be subject to market risk. Say they decide to sell it before it matures. What if interest rates have gone up? So they'll be able to sell it at a loss. Because if interest rates go up by the time that they decide to sell and not wait for it to mature, so they're exposing themselves. The price in the market could have gone down. That's one. No. Maybe for many investors, just knowing that Fed rates would go up. So some of them are parking in short term. Well, some of them are parking in short term funds because that's practically that's the same concept. Just let it mature. You earn the yields. Of course, it's relatively smaller, almost nothing actually for short term interest rate. You're just parking it there. But those who would like to get the sweet spot, meaning they get to enjoy the relatively higher yield, but it's not that long. Maybe the 2 to 3 year tenor would do. But same concept again. They should hold it till maturity so that they'll get to enjoy the high yields without subjecting themselves to the market risk. If should they decide to divest or use the money, and then as they sell, interest rates have gone up in this rising interest rate environment, they could experience some losses. But if they just let it mature, then they earn the interest earning or the coupon. So that's one way to manage the risk. Actually, but depends. There are some big funds, they can manage their balance sheet, their future liabilities with assets that they buy in the market. Like I'm talking about the pension funds. Some of them have the leeway, their future obligations based on their cash flows. They get cash flows. Some of the insurance companies, some of the pension funds, retirement funds. Some of them they can afford, and like that, the likes of banks. They can afford to, on the long end. But of course, it's matched with their the assets that they invest into. It's matched with their liability, so that's why they can hedge their market risk with that, and they get to enjoy also the much higher yield given the steepness of the yield curve. So those are the ways to mitigate the market risk while enjoying the higher interest rate returns, and some prospects also for trading. Hopefully.
All right.
Yeah.
Thank you, Mike.
Thank you.
Let me just share or take a question, Mike, from the Q&A box. So first question here would be, what are the investment opportunities for 2022? I guess, Mike, we can discuss from a top-down approach, no?
Mhm.
Maybe you can share your favorite asset classes, then reserve the details, no?
Mhm.
With the client's RM.
Yeah.
So what are the investment opportunities for 2022, Mike?
Well, now, of course, for fixed income, we all know that it would be kind of, well, it's well, we just discussed the previous question on fixed income. So yeah, for the more conservative ones, it's still there, like RTBs. The RTBs would provide a relatively higher return for as long as it's invested and held until it matures. No? Yeah, imagine the RTB, it was doing at 4.625. No? Where would you get that kind of return? Just a minimum investment of 5,000. But of course, that was raised last November. Now it would be based on existing market conditions now. No? The yields may have gone down already and the prices have gone up. So it has become a bit pricey. But of course, the consideration there is the interest income. So there are still pockets of opportunities in the fixed income market. But if you look at well, in developed countries, there's a problem because their interest income is very low and their interest rates are going up. They could experience some market losses. That's why equities are providing some opportunities with that. No, you have seen the momentum, like S&P 500, even local equities. It's holding at 7,000 because it would also benefit from the near record high S&P 500 because because it's especially if there are still bargains now, no? Um, well, we came from war-like conditions, diba? The GDP came from post-World War II lows of -10 in 2020, and the recovery story in 2021. And the PSCI hasn't really gone up that much. Uh, so it's still the recovery story. There are still investment teams like the ESG that I've been talking about, renewable power, that has been the favorite for the past 1 to 2 years. Because that's ESG compliant, no? Especially some, yeah, the shift towards solar, diba? Wind, hydro, and other renewable and sustainable sources of energy. You've seen it. Look at the IPO. One of the best performing right now is, yeah, they're doing well. No? So you look at even here locally, those engaged in renewable power, they have done really quite so well. No, among the listed companies. I'm talking about SPNEC. I'm talking about ASEN. No, yeah, but now of course some of them have gone up already, quite so much already. But that remains to be and not only that, worldwide, look at the supply chain is also benefiting. Supply chains, I'm talking about the well the uh, for electric vehicles and not only electric vehicles but self-driving vehicles. Down the supply chain up to the nickel there's been increased demand for materials for those, like for batteries, like nickel, no, lithium. So you've seen, look at some of the nickel miners have been profitable worldwide because of that, and the other materials makers for this supply chains for both renewable power and electric vehicles and self-driving vehicles, because there will be a tremendous demand for them, no, for these renewables. And telcos also, they've been doing well, especially those with digital wallets evaluations. No? That has been a key theme, especially now. Increased digitalization, uh, the remote working. There's a demand for broadband services, telco services, data, and the digital wallet. There's a high valuation for those, no, as an alternative. Uh, well, that's an entirely different business model altogether. Because yeah, they're capturing financial related businesses also, no, for some of these telcos. So yeah, those are the biggest winners actually. Yeah. So hopefully that answers it, Mike. That
All right. Thank you,
question.
Mike. Mike, I have one more question before we wrap up.
Yeah.
One guest is asking, not too sure if we can still share the slide on the auto industry, but can you give us more color on the said industry? and why it will take longer to recover?
Well, because simply more than 800,000 OFWs have been repatriated since the pandemic. But I'm sure some of them have been rehired already, or they were able to work already with the recovery in the global economy. Yeah, for instance, well, there, well, at the same time, there are some, because of the lockdowns, we have seen also the employment picture being adversely affected by the pandemic, by the lockdowns. So, of course, imagine, of course, it's a mixed picture. Those who are still fortunate to have stable employment despite the pandemic, that would still be a source of demand given the relatively lower financing costs since the pandemic. But then again, those consumers, households facing challenges on employment, on income, on livelihood, on businesses that slow down because of the pandemic, of course, they could scale back on their purchases of those big ticket items. How can they purchase vehicles? It's expensive, and they need to, given these challenging times for some of them. And at the same time, some businesses have cut capex, some they have cut costs to better adapt to this pandemic because of the reduction in sales. So that also adversely affected the demand for big ticket items like vehicles and property. So hopefully that answers the question, Mike.
Okay.
Yeah, the only thing that's upsetting this is the lower financing costs. That's incentivizing many people around the world, many businesses to borrow, to finance the purchases of homes, vehicles, and invest new investments and expansion projects. So yeah, that's the reason why the central banks brought down interest rates very low, able to stimulate demand and stimulate the economy. But I think it's kind of overstretched already. Look at the housing market in developed countries. The prices have gone up because of that. So that's why the central banks have to regulate also and try to bring back to more sustainable levels because of the inflation that entails. So it's a mixed picture actually, Mike, for different countries. For the Philippines, it's an entirely different story. For developed countries, it's also a different story altogether.
All right. Thank you, Mike, for sharing your actionable information with our valued clients and guests. No, I believe that's all the time we have for this afternoon session. I'll now turn over the floor to Ms. Lavinia.
Okay, so thank you so much, Mike, for expertly going through our clients' questions and discussing them with our speaker. They were very helpful, even for me. And for Mr. Mike Ricafort, great and very informative presentation as always, sir. Thank you for continuously supporting RCBC Wealth Management, and we appreciate having you with us today. To our dear clients, thank you so much for taking the time to be with us. We hope that you were able to add value to your afternoon through this session. In case we were not able to answer your questions here, we will be getting in touch with you directly within the next few days. Also, for those who have placed their questions anonymously in the chat box, kindly reach out to your RM so that we can reply to you accordingly. Before we say goodbye, we would like to invite you as well to our next webinar on cybersecurity. This will be on January 27, that's a Thursday at 3 p.m. We have invited 2 speakers who are experts in the field of cybersecurity, and they will be sharing their knowledge on the various ways to protect our personal details, the risks and threats attendant to the digital landscape, and the steps and processes that RCBC has introduced to protect its clients. We look forward to seeing you on January 27. Again, I'm Dee, and together with my co-host Mike, it was a delight being your hosts today. A wonderful afternoon to everyone. Bye.
Thank
Bye.
you.
Thank
Thank you so much.
Bye. Thanks, guys. Thank you for attending, everyone.